Mantell, I am so excited and blessed to have you in my life and on the show here today.
It's a pleasure being with you.
Put Your Numbers to Work is about finding people who are really great at putting numbers to work and getting them in here to talk about why that is so important and how you do it, not the creating of the numbers, but using them. So first off, we have met 14 years ago, and you have become my most trusted advisor. Thank you.
You're very welcome. It's always been a pleasure, both personally as well as to be a member of your outside board and helping GrowthForce grow over the years and become very profitable and one of America's leading companies that provide outsourced bookkeeping, accounting, and controller services. So it's been a great pleasure. And in a way, we're not going to talk about GrowthForce all this time, but you are indeed a great microcosm of the success that we focus on, for sure.
Well, the best part is it's so much fun together with you. I mean, it's
Right.
like every day, we meet pretty much every other day for 10 years.
Talk about the business.
To talk about the business and our partnership with Disparity. We met through Jay Minks.
That's true.
You are the owner and managing partner of Independent Consulting Associates. Independent Consulting Associates.
That's correct.
And you got 6 partners, and we've done lots of work together.
We have indeed.
In fact, we have RC's Pizza is one of our mutual clients. We'll give Wes a shout out. And what I love about your business model and your whole approach to life is that you really come to business strategically, right? You think in terms of what is the business plan.
That is true.
And when I was starting GrowthForce and we met, that was what you first started coaching me on. So talk about, what are the best practices in building a business plan?
Yeah, sure. I'd be happy to do that. There's some very recognizable common denominators in developing a plan, but over the years that I've been fortunate enough to own and manage ICA, as we call it, Independent Consulting Associates, and we've had approximately 35 clients. The common denominator is that when a business owner comes to me, it's typically through a referral. The owner is in what we call a point of inflection. The owner somehow is stuck figuring out how to get to the next level. That's almost a common denominator. So what I do on a very informal basis, just as you and I did, I sit down with the owner and I say, John, tell me first your vision for this business, your mission of why this business is important to you and to your customers, and tell me a little bit about the values that you embrace in building this business that you passed on to your employees, and the way people are an important and an integral part of your business.
So it's mission, which is why you exist. It's vision, where do you want to go?
Correct.
And then
your values.
Who are you?
Your values define your culture.
So I never realized how important that was, and then we became an Disparity client, and we defined that. Marcia Gibb became the epitome, and it changed everything. How do you use values in a business? Why is that so important? Why is it such a difference maker?
Well, because values determine culture, and it's very, very important that the employees that you hire, you train, who are the most important asset to the success of your business, embrace the same culture, the values, and the mores that you yourself have built this business upon.
Why is it so important?
You're all aligned in achieving the same kind of goals. You have a mutual respect for each other. You treat not only one another but all of your customers in a manner that you wish to be treated yourself. So the alignment of that particular part of the business allows many great things to happen. Employees embrace the business. They're twice as productive. They don't see the business as a job it's a mission.
Mm-hmm.
They're there every day
Mm-hmm.
because they choose to be,
Mm-hmm.
not because they have to be.
Their higher purpose, why God
It's a
put
higher
them on
purpose,
earth.
correct.
So when they get out of bed in the morning, they're excited. So and they don't quit.
Well, and the smart business owner, once the business owner defines the parameters of, let's say, I like to do business planning in 5-year increments,
Mm-hmm.
just like we did.
Mm-hmm.
So the very first thing is I ask the owner, once we get these fundamentals defined, where do you see the business being in 5 years down the road? Just like you and I talked about. You know, what kind of revenue do you want to generate? What kind of products or new products do you wish to offer? How many customers would you like to acquire?
Mm-hmm.
And since nothing happens in a vacuum, you need to very acutely understand your competition that is in the same business segment, that may offer the same products, that deliver through a technology. It's got to be a level playing field. You have to understand that. Once you develop the parameters of the business, which include funding, how are we going to fund growth? Where are the sources of funding? Is it going to be through a commercial bank? Is it private equity? You know, and then going down
friends and family, credit
friends and
cards.
family. And then we try to figure out, as you're going down the road and you're growing, when do you break even? When do you become cash flow positive? And then when are you going to be able to hit the KPIs and profit that you're looking for? When do you hit that internal rate of return? When do you know that an 18% return on your investment requires a 65% gross profit?
Okay, so let's get started with that, right? So what's the first step? You figured out, you figured out why you exist. What's your unique selling proposition and you versus the competition? Then you figured out, that's step one, and we're describing the 5 steps to profitability.
Yes, that's correct.
Which I didn't never really equate that, but that's what we're doing.
That's what it is.
And then step 2 is talent management and culture and core values. Now step 3 is your goals, right? So you're doing that financial projection. What's your 5-year revenue? So how do you do that? How do you get started with your first budget?
Well, the first thing you need to do is examine the current case, and that's to totally understand where you are today. Mm-hmm. The next step is, as you build toward a revenue base, moving, for example, from, if you're at 2 million today, and next year you want to achieve 4 million, 8 million, 15 million,
100% growth, that's pretty good, okay.
Then you need to put all the components together. Most importantly, if you have a client base already established, how do you expand that base? Do you sell more products to your current customers? Do you go out and find new customers? It's probably a combination of both those things. Mm-hmm. And speaking of profitable customers, as you go along, the measurement of which customers are the most profitable is understanding the whole business.
Now you're talking my love language.
There you go. Here's a pitfall where many small business owners fall into, and the reason they do that is they're really focused on what they do best, whatever that is, but it's really not on understanding the principles of management accounting.
Not at all.
They don't do that. So, we try to help them understand that. Here's a great example. Recently, I had a logistics company over here in Humboldt, Texas. Mm-hmm. Family owned, 10 million in gross revenue, wanted to double the business in 5 years, and had 3 or 4 different entities in the logistics theater. They had logistics, they had factoring, they offered transportational services, they offered insurance and so forth.
How big of a company?
The company was currently 10 million.
Okay.
And when I asked the owners, you've got quite a client base here, who are your most profitable customers? And what they did was they made the common mistake of saying, well, that's very simple. It's this customer because they generate the most revenue.
Top line.
Top line.
Right.
So we did an analysis and we found out, well, guess what?
Nope.
This customer, in many different cases, not only was not their best customer, because the margins were very thin, even though the volume of sales was highest of all, but the return goods, the low pricing, the competitive pressures.
The amount of extra time that client required because they're
Yeah, absolutely.
great big PITA.
Yeah, and the additional manpower that they had to put on that account.
And senior manpower because they're the biggest client, so who gets their attention?
That's exactly
The
correct.
most expensive people.
Yep. So management accounting, as opposed to what I call static accounting,
Or financial
or
accounting.
financial accounting, such as audit and tax, this type of accounting that you folks do is totally different because it really represents the language of how we measure business performance.
Mm-hmm.
Then another thing that's missing is we do an analysis of their people. The productivity of their people. How do you measure, if you have 15 employees working on different jobs, what they actually produce? So we spend a lot of time studying how much their salaries and wages are, how much is dedicated to each client. Then we try to get it down to job costing, how much is actually dedicated to each job, so we can go back and measure individual contribution and profitability associated.
So let's
with
dig
that
into
type
that.
of a job.
This is great because I do, I hear this a lot in my Vistage speaking. This is what almost every CEO wants, but it's elusive. It's hard for small businesses. You built your career at Exxon, right? And we're on that Tony and your tiger tail. Is that you? That was you.
34 wonderful years.
That was you.
Yeah.
So, so how do you do that? So let's start with the time tracking, right? So the businesses don't want to have a burden of having people fill out timesheets, but now it's on your iPhone, right? So assuming you can capture your time on your phone, why is that valuable?
Well, it's valuable because it gives a precise measurement of the exact time dedicated to a specific job.
Mm-hmm.
It used to be in the service business that only companies such as law firms or CPAs that bill for time was extremely important, not only to ensure profitability, but to ensure that the client himself understood what he was being billed for. Mm-hmm. And people are comfortable when there's a degree of transparency.
Right.
So we're not hiding anything.
Especially when you're charging $350 an hour.
So that's exactly correct. But in reality, being able to measure and track and bill for time, remember the two components of the business, Steve. Time is money.
Mm-hmm.
And if you don't understand the relationship, whether you produce screw machines, you're in logistics, you're a dentist,
Marketing,
you're a CPA,
marketing consultant,
you're a marketing consultant.
nonprofits. We're on the board of directors of Village Learning Center.
We are, and there is a great example.
Unit economics, right?
We converted a static accounting structure to what we call unit economics, where we can measure profitability by class of trade. Mm-hmm. and get for the first time a real understanding of what pieces of the business make money, what pieces of the business break even but are essential, and there are certain pieces of the business, of any business, that simply don't make money, and you, at the end of the day, you don't want to keep focusing on a piece of business that's losing money.
So you mentioned a couple of really interesting things there. So in the nonprofit world, you need to run the same way as a for-profit, right? You're just reinvesting the profits back into.
Yep. A nonprofit is a business.
Yeah, and what's interesting, Anne Marie, our director of development, is using the unit economics to go to the donors.
That's
and
right.
say it costs $10 a day for transportation services. Can you give us $100? So let's come back to the for-profit world. So your business plan. You're trying to set the goals. you're trying to figure out 5-year vision for sales. How do you build that sales model?
First of all, I study 3 or 4 components of the business. The first is the industry the business is in, because that's going to dictate a certain aspect of the approach. If you're in manufacturing, light manufacturing, for example, you might build the business at a little different pace and a little different structure than if you were a law firm.
Services businesses is what we focus on. What would a service business do?
A service business builds their entire model on acquiring customers, being competitive with their rates, understanding profitability, and understanding how they are going to fund growth. That's very, very important. We talked about that earlier.
So let's go, what's step one?
We then establish, we can even go down by customer. You know, what type of revenue do you need to generate from this customer with this set of expenses and this number of people dedicated to that client in order to make a 20% return?
Or whatever your gross profit.
Or whatever that goal is.
So there's taking a step further. So you're saying, what is the revenue that you're in a service business? What are the revenue your people are going to generate? And then what does it cost you to have those people?
That's exactly correct.
Your direct labor, right? The above the line costs.
That's what we call it, above the line labor expense.
In cost of goods sold, direct labor, to give you a gross profit, and you're interested in it as a percentage more than $1.
Absolutely.
Why?
Because percentages are a better way to measure what I call the efficacy of growth versus simply dollars.
Mm-hmm. Efficacy is a big word, so
Yes,
explain that to me, please.
The efficiencies of growth.
It's the efficiencies.
Yeah.
So how well you're operating, how well you're managing your people.
Correct.
And so you're going to figure out what is the unit economics of a client, how much you're going to charge them, what's the people that's involved, what's the cost, what's your gross profit, and then what? You know that client economics.
Then you're going to actually look at each particular aspect of the business. As we say, unit economics, if you have 8 different revenue streams within a business, for example, and on a weighted basis, you need to know each individual number on the bottom line. And on a weighted basis, if your projection is a 15% return on the bottom line, that should equate to a numerator of growth for that particular year.
Okay, let me see if I can break that down, because there's a lot there. So first is you are looking at unit economics for each of your individual product lines. What does that mean? That means the gross profit, the revenue for each client minus the direct labor and any direct materials is your gross profit, and then dollars and percent. Let's say you have 3 lines, and then you said weighted average. So you're going to say, okay, what's my client mix? Are 50% of my clients going to be these small ones, and then 25% be the large ones, and the rest be the middle? Is that what you're thinking in terms of weighted average?
I'm thinking more about a weighted average as really to examine and determine which clients are most profitable. So for example, if you set a reasonable expectation for your company that you're looking at retaining clients that bring in a 65% gross profit. If you're looking at retaining clients where after expenses are placed against that number, you can make a 20% return on your capital employed.
EBITDA.
EBITDA, if you wish.
So go to that last step, the return on that investment. What is the investment and how do you measure it?
Well, you can measure investment in a number of ways. You can look at investment simply as a simple return. You can say, all right, a good measure of that investment is the return over a trailing 12-month period.
So you're talking about how much money you spent on the people, and then how much profit you got from the people?
Oh, understanding profitability by employee or by business unit.
By team?
A team, a group who is assigned to a specific client is really the fundamentals of understanding the profitability or lack thereof of that particular client.
Mm-hmm.
A lot of times I've witnessed where business owners will hang on to a customer, even when we've done an analysis for them and they're losing money because they're afraid to lose that client.
Or they're afraid to lose the cash flow.
Or the cash flow.
And what I find is those low margin clients cause the cash flow problems. And most business owners I talk to, we have one in Boston, an Insperity client. They do IT consulting. Apple was their biggest client. And they were so proud of Apple. It was on their website. They were losing money, hemorrhaging money on one account because management spent all their time there. They couldn't find enough people to do the work. We said, take those people off of Apple, put them on here. They went from break even to $1.5 million in profit in 1 year.
That's a great example.
1 year. So, you know, it's interesting. You're in marketing and you primarily are like the sales side. Most organizations pay commissions on gross revenue, on sales, but you know, I know Insperity does it. Although the smarter companies pay pay commissions on margin, right? Talk about that. Have you seen that in small businesses?
Yeah, I have, and to me, it's a much more intelligent way of paying in that regard. Because if you're a top salesperson, here's where sometimes people get fooled. My top sales guy sold $1 million last year.
Right.
At a 1% margin, because he cut the margin almost all the way to nothing to build the volume.
Selling commodity, not value.
Correct. My next guy only sold $500,000 at a 40% margin. And this guy was profitable. And all of the metrics that I judged his performance on were either at or above objective. And that's the way you have to manage the business. Without using really good management accounting and focusing in on all of those subtleties. Now the problem, and it's not a problem, but you know, for a business owner, regardless of what you produce or a service, you know, unless you've had an opportunity to either major in economics like I did, or finance,
Or accounting.
You know, these are not things that most people just intuitively come to understand.
Or enjoy.
Or enjoy doing.
Right.
Right.
So you bring something really unique. It's kind of an understanding of how to use, you know, management accounting, and that's a phrase that we hear a lot. How would you define management accounting? What is it? Why is it different? What's the difference between that and a CPA?
Well, for example, my own opinion, of course, is that a typical CPA firm, and I think it's one of the reasons where CPA firms today are in a quandary about hiring new and good people, because the work that they normally do is tax and audit.
Right.
And that's what I call, and don't get me wrong, it's a very needed service in America.
I'm president-elect of the Houston CPA Society, so be careful here.
Of course. We'll try not to indict you here in your chair.
But what's your honest opinion? Because this is
my honest opinion is that static accounting is really a good thing when you're doing tax and audit, because it is a backward-looking approach to ensure compliance.
That's it.
Okay.
Good for compliance.
Management accounting is a forward-looking approach that uses a good set of indexes to average, to measure real-time productivity, real-time sales, real-time performance against a business plan.
So budget versus actual?
It is a budget-driven versus actual structure. It allows you to really understand the relationship between the costs that it takes to do something and the resulting revenue over time.
Over time.
Yeah.
Right. So I just want to restate one thing you said there, because I think that's interesting. You're looking at management accounting matching up with the budget, right? Budget versus actual. So that's a big definition. So in step 3 was was goal alignment, right, of our 5 steps. So you help somebody with the financial projections, and the projections model becomes the chart of accounts.
That's exactly correct.
For the general ledger.
Right.
And then when you do step 4, which is keeping score, you're reporting your actual results, and it's matching exactly how you budgeted in Excel.
That's correct.
So then what happens? So you have to do budget versus actual, because if you don't do that, you're missing half the story.
Well, that's correct. Now, what I do with my own clients is that we set an annual forecast. You call it a budget, I call it a forecast. Mm-hmm. But let's say, for example, you start with a 5-year business plan, and let's say you're in the 2nd year. So you have the opportunity through management accounting to go back and look at that first year in all of those disciplines you just talked about. Now, moving forward, you say, all right, I'm going to now adjust my forecast accordingly, and more importantly, in order to achieve the revenue that I'm still needing in the 2nd year, what are the variables now that I need to fix?
The drivers.
What are the drivers? Is my labor cost too high?
Because that's your biggest expense.
Are my margins on what I thought were my most profitable clients unacceptable? And so forth. But then the most important thing is, what am I going to do tactically to fix it?
So what decisions do you have to make? What levers? What are those decisions?
Well, in some cases, they're just not really very pleasant. You have a really good client, they've been with you a long time, but you know their margins are such that, and you want to keep them. So I found over time
So the decision is firing your low margin client.
Well, what I suggest for my clients is, before you do anything drastic, and if it's a long-term client, in the interest of your culture, you would meet with that client head on and say, you know what, John, you've been with me for 5 years, and I have to tell you that in order for us to continue together, and I want this to happen, believe me, that's why I'm here. We have to make some adjustments in our pricing.
So decision 1 is pricing.
Correct.
Who do you have to price? Decision 2 is, which clients do you have this difficult decision?
That's correct.
So what do you give them options? You give the client options?
Well, we try to work as best we can to convince him
or her
that this approach needs to happen.
Right.
It needs to happen.
Right.
It's not an option. I cannot afford to go out of business to please someone.
100%.
Okay. What I often do is I will go out to 4 or 5 key competitors, and I will say, you know, by the way, your key competitors, John, are A, B, and C companies, and as a matter of fact, you know, the cost of goods, from what we've been able to ascertain, is significantly lower than yours. So we need to make some adjustments here.
It's fascinating. So you're doing when you're about to fire one of your clients, you do a competitive analysis of that client. And so so I didn't understand that last part. So say that a different way.
Which last part?
So then we talked a little bit before about the management accounting's biggest value is decision making, having data-driven decisions. And let's talk a little bit about the most important decision a business has to make, which is pricing, right?
Certainly one of the most important, yes.
Absolutely. You can't have strong financial performance without proper pricing. And so spending some time here as a business owner is really critical to success. How do you go about figuring out that pricing?
Well, what I suggest to my clients, there's several tactical approaches to pricing. The first thing that we do is we have a competitive intelligence model that we've built. And regardless of industry, it captures the same kind of information. So if you are producing or offering a product that's essentially similar, Not identical, but essentially similar.
So let's take a marketing consulting or management consulting.
Okay. So, the very first thing you need to find out when you go out into the marketplace, who are your key and primary competitors, and how much are they charging for that product?
Mm-hmm.
Now, the better your company is, the greater your value proposition, perceived or real, the higher margin and the higher price you'll be able to charge, because the perception is it's worth that.
Right.
Okay.
So you're paying for good service.
Correct. But however, if challenged, you're going to need to prove that.
Mm-hmm.
So that's a good thing. Secondly, once you've determined a price, one of the greatest aspects of being able to do both job costing and unit pricing is you need to build your costs associated with delivering a product.
Okay.
And then see from a cost forward basis if that pricing at this level of sales is going to give you the gross profit and the net profit you need to hit the target in your business plan.
Okay, so you're saying is that when you're trying to put a price on a proposal, or you're trying to put a price on a product on a shelf,
correct,
you got to look and really understand the true costs.
True costs.
So let's talk a little bit about.
Well said.
Let's
True
talk
costs.
about. So you know, I see a lot of times that business owners don't understand the concept of fully loaded labor cost. They do a bid and they say, okay, I want to make a 66% margin, so here's your salary is $50 an hour. I'm going to bill you out at $150. But they didn't have the taxes, the health insurance, the 401k, the recruiting, the training, all the components. Talk about burden rate for a second. And
That's exactly right.
so how important is understanding that fully loaded burden?
When you're doing a cost forward analysis, especially on labor, you need to totally understand that salary is just a piece of the fully loaded cost.
Probably 75%.
For example, probably in that range, 70–80%. Now, on top of that, there are things such as benefit costs, FICA, health insurance, travel time, all of this
Recruiting,
stuff, recruiting,
training,
all of these components,
employee engagement expense.
all of this in kind of an inverted funnel with actual salary at the top, and you're going to put 4 or 5 different people on a job. So without knowing those fully loaded, I like the term you use, the burden. Good term, Inspirity's term, I like that.
Yep.
That's the book cost burden.
Sal Gervasi talk.
Yeah. You know, just by marking up a job by 50% is a meaningless number.
Right.
Unless you know, after you have gone through a cost forward analysis, what that actually is going to provide in terms of a return. And then you need to know on a sliding scale of revenue, right? If you can produce, if it takes 5 people, here's a good equation.
Okay.
If it takes 5 people to produce $100,000 worth of revenue for your company selling a widget and delivering the product.
Or providing that as a service.
Okay. And if you can get to selling and delivering $130,000 with the same employee complement, and the delta could simply be discretionary effort.
Right. And alignment.
And alignment. You need to be able to measure all of this. But your gross profit could jump from 40 to 70%.
Like that. So you just talked about you need really a financial management strategy and a human capital strategy in order to have performance and growth.
Well, that's correct. If you remember, Steve, we went at the very beginning of this interview, we started talking about the importance of vision, mission, and values. And values, we talked, if you recall, related to the culture of the company. So the types of people that you hire obviously need to have the fundamental skill sets to produce.
pay the bills.
However, you are looking for people right from the time before they even join the payroll that embrace the same cultural beliefs that you do. They buy into the mission and the vision of the company, and it becomes to these people more than a job.
It's a vocation.
It's a commitment.
We're on a mission.
I like that word.
So
it's a commitment to success. And so you have this group.
You recruit for behaviors and not skills, is what you just
correct.
said.
You
Okay.
recruit for behaviors, assuming that the skills are given.
Right.
Okay. And then it's important that the new employees, whatever they're doing, whatever they're assigned to do, whatever account they're assigned to, or whatever their mission is, that they are totally aligned, that you can measure their performance and reward them accordingly for both effort, for profitability, whatever set of metrics you make up. It's almost like setting some individual performance KPIs, key
like
performance indicators
I like that. So you were
for your employees.
So what you're saying is that each person should understand what success is for them, and that has to get cascaded from the company to the department to the team to the
Correct.
individual.
And then,
Talk about that.
yep, it does, because, for example, if the business owner himself or the management team embrace a culture of servant leadership,
Yep.
that culture and the mores that support that permeate all the way down through the organization, all the way down to the individual. But in retrospect, the way it's really functions at the end of the day is that it also goes back up, because employees understand their role.
Right.
They understand their fellow employees' role, and in unison, they do what they do, not for themselves, but they do what they do for the customer
And for their team.
and for their team.
They won't let the team or the customer down.
There you go.
So that is fascinating, because you just described what life is like here at GrowthForce.
Yeah, and there's one more point, that they need to be rewarded in a way that fits the culture. And money, I tell you, is only one small aspect of reward.
It's short term.
It's very short term. It's employee recognition.
Yes.
If you can measure discretionary effort.
How do you do that?
Well, there's several ways to do that, but, most importantly, you have somebody out working with a client, and they're just ready to solve a problem, and it's close to quitting time, close to 5 o'clock. And that employee says to the customer, you know what, if it's okay with you, I'm going to stay here until this job is finished. It might take me 3 more hours, but don't worry, I'm going to take care of it. That's discretionary effort, and that needs to be recognized.
So
And there are some things that never get put into a customer's bill, but the customer knows that.
right,
They can feel it.
right,
They know you have their best interest at heart.
right. You're a partner,
Right.
and you have that by having engaged employees. So you're recruiting.
No question.
You're recruiting for them, and then you're going to give them clear written goals, and and they can see a line of sight between their daily activities and the success of the team and the company.
Absolutely.
And then you're going to keep track of their actual results against that plan, and then recognize and reward the ones who contribute the most.
Said even better than I could.
So what does it look like in terms of the the recognition and rewards, right? How do you put your numbers to work there?
Well, for example, if you're a business that tracks and bills for time,
Service business, yep.
service business, it's very easy to look at the time dedicated to a specific job, and if that employee who performs, if that particular job, either as an individual or as a group, as a team effort, is able to generate some substantial income and profit, right, over and above the established number, that employee, if it were my business, Stephen, they would share as a bonus.
I agree.
In a part of that, because that is the essence of discretionary effort.
That's exactly what we do at GrowthForce. We
Yep.
we have a profit sharing plan where there's 3 measures of success: employee retention, client retention, and hitting target sales at the target audience.
Yeah, absolutely. One thing you can always tell, especially if I'm about to take on a new client, or even occasionally going back and working with a former client, one of the first things I look at is the incidence of employee turnover.
Right. Why is that so important?
Employee turnover really happens for a number of reasons, but lack of financial treatment or salary is basically down the list.
It's not about the money.
Not about the money at the end of the day.
Right.
When I've interviewed employees that have left companies, I am not appreciated. My discretion, I was never rewarded for anything.
Right.
So I stopped trying to be the best performer I could be. I was disenchanted with a large increase in my benefit costs.
Wow. That's interesting.
And then finally, and this is a rare occasion, a competitor offered me 80 cents an hour more.
Right. It's not about the money.
Yep.
People join companies and they quit bosses. And what I'm always amazed around is how, the senior management's usually great, core values, understands the business model, how you make money, but now you get to the people who are actually doing the supervision, they don't understand how the company makes money. In fact, I've been surprised in some of the business speaking, the employees think that their top line revenue is the profit that the owner takes home.
Yeah. Now, one good way to correct that problem, I know you guys do it here, is in certain instances with clients, I'll do an alignment survey. And I start right at the top, and there'll be 8 or 10 questions, and I will say to senior or executive management, start right out, and I want you to individually write down the vision, mission, and values of this company. Second question, do you believe all employees are treated equally? Third question, in compensation, do you reward for discretionary effort? Are your policies open? Can employees communicate freely without fear of reprisal?
Which is critical for reducing fraud too.
Absolutely. And then I'll go to the next level and I'll ask them the same questions. When I get down to what I would call middle to lower middle management, you would be amazed, Stephen, at the number of times, and I take it back, and it's an anonymous survey, and I share it with the most senior people, and they're stunned.
Right. Yeah, and then you wonder why people quit, right? They quit bosses.
There is no alignment
right.
between the top and the employee. Somewhere along the line, those key messages,
right.
the culture breaks down,
Yep.
and it's not what they think it is.
Exactly.
And they're gone.
So how do you change that? Well, I'm an Asperity client, so I have it.
Well, you can talk about that.
Well, at every company meeting, we actually go through these 5 steps. It's like, what is our mission, vision, and core values? Then we recognize the people who have anniversaries, because employee retention is our most important. We got people here 12, 13, we just hit 14 years. Then what we do is we celebrate promotions from within, recognizing the people who are growing, helping us grow. And then we have this thing Insperity taught us, most managers try and catch you doing something wrong. We were taught to catch people doing something right. So we have kudos.
That's great.
At growthforce.com, where any employee can send a kudos about a peer, client, nice email, or somebody helped me out on another team, or whatever it is. And then we celebrate the person who got the kudo and the person who said it.
I'd like to leave it this way, that the business owner who makes the ultimate connection, simply that the aggregate performance of his people will determine whether he achieves the goals of that business plan in revenue and expense. That is the key goal. If there is no alignment between the performance of people and the business objectives and how to get there, it's a very disjointed structure.
So is that the reason you think, because I've always been surprised, I see so many, we do KPIs for Vistage groups when I speak, and I see
It's a great organization.
100, and I've created, over 100 KPIs now, and I'm amazed how many businesses have real strong, solid top-line growth, but they're not making any money. They're breaking even, or just a little bit, 5% net income. Is there anything? Let's talk a little bit about how you use management reporting to help you increase that bottom line. So we talked about the pricing, we've talked about employee retention, right?
I think we have to talk about the biggest component of expense, and that is salaries and wages. So there has to be an analysis, and I think the way you're doing it here by charter of accounts is a good way to do it. I think there needs to be a function. If a business has 8 or 10 large clients, then I think you need to break that down. If you can go further by product, by service, but in order to accurately understand, for example, if you have 10 things that you do, 2 or 3 of them may be producing excellent results, and then the other 6 or 7 may not be.
Right.
And why typically is that? The manning, the staffing is out of alignment, and the costs associated with that particular business line need a very close look.
So let's talk about how you do that. So one of the things that we really first met with was with Insperity Integra.
That's correct. We worked on that task force for many years.
That's how many years is that? 10, 12 years ago?
A long time ago. Yeah.
And now Insperity Integra 3.0 is launched, and there's time-driven, activity-based costing for Insperity clients, and only Insperity and QuickBooks Desktop have automated time-driven, activity-based costing. Let's talk a little bit about what that is, right? So here's the backstory. We were when we became a client of Insperity 11 years ago, Sharon Gould was our director of operations. She said, I gave me my financial package. I said, where's the P&L by customer? Well, we're talking about right now. Where's the P&L by team, by service? She goes, oh, we're not going to get that anymore. We switched from Intuit payroll, where they have time-driven activity-based costing and job costing. We switched to Insperity. So we don't get that job costing anymore. I said, well, that's one of 2 things is going to happen. We're going to either fix it for Insperity, or we're going to fire Insperity, because if I can't see my profit and loss by customer job report, I can't make any of the decisions that we've been talking about all day. Right? The most important are my P&L by job. So because of the relationship, we got to build the exact same thing, so it takes timesheets out of QuickBooks. Doesn't matter how it got into QuickBooks, right? We use T-Sheets, or you can use TimeStar or Spring Ahead, or there's a million time tracking systems that feed QuickBooks. Grabs those timesheets, grabs the Insperity fully loaded labor costs, right? So it's the payroll and the taxes.
You're bringing together now all the components we're talking about.
So talk about, so it takes the fully loaded labor costs, divides it by the number of hours to come up with a cost per hour, and then takes the timesheet and posts that by customer in QuickBooks, online and desktop. The actual labor costs per customer, per job, per class, which is department in QuickBooks, per service item, and then now you can see profitability by customer, by job, by department, or
well,
service.
all right, I think you've answered your own question, because if all of your friends at Vistage had the capability of doing that,
right,
through this Integra system that Insperity is going to offer very soon.
It's live now.
Live now, even fantastic. They would be able to go in and make that analysis and say, you know what, our revenue is increased by 10%, but something's wrong here, because they really don't understand, because they don't have a methodology to drill down specifically to look at revenue by customer, cost by customer, you know,
Gross profit.
gross profit by customer. And other than the fully loaded HR expense, which is the biggest component of cost, then all of the other operating expense billed that should be billed directly and in line with the customer. So it's all the way, it's a top-down driven structure. So you can look at the bottom line and say, oh my goodness, we lost money on this customer over the last 6 months, and we had $1 million worth of revenue.
Right.
What happened?
Right. So you can also then, you talked about having to have that difficult conversation with clients. This time-driven, activity-based costing allows you to see the real value that you're giving away, right?
Sure.
Your time leakage and your things you forgot to put in your bid.
Absolutely.
So then you can go back to your prospect and have that conversation.
Yeah, when at ICA, when we take on a new piece of business, and let's say it's to develop for a small business an investment grade business plan. So we give the owner a very detailed scope of work,
Mm-hmm.
and it's almost by phase. And in my business in particular, I do strategic planning. I have another partner who does branding. I have another partner who specializes in funding. I have a partner who's an attorney who does contract and litigation work for small business. And when we put the whole component together, it allows us to see if we're going to have several different individuals contribute to a project, how much that's going to cost, what other expenses are going to be required, i.e. travel,
Mm-hmm.
trade, etc. If that's a deal. And I mean, no one is in business to break even.
Right.
So we add the profit margin that we need.
So let's start. So when you're doing your pricing, this is really, glad you mentioned this, because
Yeah, it's very important.
when you're doing your pricing, you're thinking about your costs to get your gross profit, and then you're thinking about how much net profit do you need to take home.
That's correct.
And then your pricing has to cover not just your gross profit, but all the overhead and leave extra.
That's correct.
So you're working backwards from how much money you want to put in your pocket. Is that right?
It's all cost driven, correct. From bottom line up.
And the first cost you think about is how much profit do I want to put in my pocket?
There you go.
I love that. I never heard it said that way. But your pricing has to cover your cost of goods sold, your overhead, and your target profit.
Correct.
And what the find most businesses don't do that when they're looking at pricing, and then they wonder why they're at break even, right? Because the impact of discounts kills you. Part of my deal is we talk about if you give a 10% discount and you have a 30% gross profit, you got to sell 50% more business
Yeah,
to make
there's
more money.
one more little component that you've missed, because I've missed talking about it. If you're in a manufacturing business, for example, and you're doing a quote, I had a client recently, 4 or 5 years ago, that produced valves and pipes.
Mm-hmm.
So the raw material, the cores as they were called, that come from the factory, could be subject to price increases.
Mm-hmm.
So in a quote, in his quoting system, we added, other than that piece, of the pieces we just discussed, a contingency that if a price increase from the mill came, it would be covered. And the client agreed that that was fair.
Mm-hmm.
However, had we not discussed it, and that's a norm in that business, that
Right.
our price increases, that if we had not discussed it in that way, it was, well, you never told us about that, we're not paying for
100%.
that.
Right.
And guess what?
They were
At
right.
that particular point, half of your profit is gone.
Right. Now, labor costs are going up, right? Especially in service businesses.
Absolutely.
So you really have to have your finger on the pulse of your labor costs.
You see, if I'm doing a 5-year plan right now, and labor, because of the wonderful low unemployment situation, which is great for the country, But if I'm going to forecast a 5-year plan, I'm going to build a labor cost increase.
Of what? What percent?
2.5% to 3% per year.
That's not bad. Okay, I would agree with that. So Peter, that's a great way to kind of summarize what we've been talking about here today. It's
Sure.
it's the best hour I've heard on how do you build a business plan that will actually help you increase profits, right? Improve performance. And we started with, you need to understand why you exist, your mission, your vision, your core values. You need to recruit for those core values and not for skills to pay the bills. And then get everyone aligned around the clear goals to drive profitability. Then you talked about the scorekeeping and how you have to have the budget and the actual lined up. And then how you need to recognize and reward all the people who contributed the most to profits. I mean, that you've outlined our whole 5 steps to profitability brilliantly. I didn't realize that when we started today that's what it would end up being.
There's a lot of things, yeah.
So thank you for your time. This was really fun.
It was fun.
I think that hopefully we're going to help a lot of businesses combine that financial management strategy and their human capital strategy and put not only their numbers to work, but their people to work.
Yeah, you know, that's one of the reasons where this kind of work, Steve, is extremely rewarding.
Mm-hmm.
Because most of the time you go in to talk to a prospect, whether it's a GrowthForce prospect or an Insperity prospect or one of my own prospects, and when they understand that you're there to help them,
Right.
and they recognize they need help, right? You've got a good marriage for a long term because you're aligned in the way you think.
Exactly.
So I can't tell you how much I enjoyed today. It's been a wonderful experience visiting, and let's do it again soon.
I love you, man.
Well done.